Hey, wealth builders, Simon Dixon here, and welcome to another emergency broadcast. I only do emergency broadcasts when very, very big events in the financial system, in Bitcoin, in investing, in money happen that I believe everybody needs to be aware of. So today, obviously, if you haven't been under a rock, you will know that there is a very, very large situation that's being dealt with right now, and the government, FDIC, the Fed, are all going to be making announcements today and acting upon Monday on an emergency situation that we're going to be covering today. But as always, I want you to understand it from first principles so that you can know how to react and how to manage your affairs. If you have been a long-term subscriber or follower of mine, you'll know that for approximately 2 decades, and the last decade over, 13, 14 years since we created our first video on YouTube, you'll know that we have been completely prepared for this scenario. And I'm going to jump into a few slides to make sure that you have absolutely what you need to know to understand all the stuff you're probably going to see on TV that will be presented in a slightly different way. But I want to make sure you understand it from first principles so that when you're going on Twitter Spaces and all these different things, you can understand it from a perspective of going down from the foundation. Right. So we're going to dive into a few things today. Firstly, we're going to go into Silicon Valley Bank, how it happened, what the background is. We're going to look at what led us to this, Silvergate Bank as well. And then we're going to look at USDC, stablecoin, and impact on wider crypto markets. And then we'll end on more of the geopolitical grand macro things so that you can understand that. And that will lead to us heading over to a Twitter space. I'll be joining a Twitter space where you can join me. Just head over to my Twitter account. You'll hear, you can click on my photo and say join space. And I'll be covering commentary alongside a number of experts from different perspectives as this all unfolds and the announcements happen in real time. If you haven't got time for that, don't worry, I'll condense it down in future videos and just give you what you need as always. So just before we jump in and head over to the slides, hit the like button for me right now. This is very important information. YouTube, the algorithm needs to know that you like it. So do me that favor and I'll continue to create content for you. And if you're not a subscriber, hit that subscribe button, hit the bell symbol, hit all, and YouTube will notify you. And then I'll make sure that you're on the right side of all these financial changes that are happening in real time. Okay, enough of that. Let's jump straight into the slides. I'm going to try and do this in approximately 30 minutes, but we'll see how we do. I've got a lot to cover today. So today we're going to be covering the death of Silicon Valley Bank, the background, what is the impact on the wider crypto markets and Bitcoin, and then the geopolitical issues that you need to be aware of. So let's just jump straight in right now. So firstly, as I said, please subscribe and let's pick up the first thing. So starting from first principles. If you're familiar with my book, I published, this exact scenario, prepare people for this scenario. But it really began from this situation, probably in 2000, when it kicked down the road a bit further, leading to 2008, where essentially, because we have more debt than money, and we use Keynesian economics, which believes in governments creating money to step in and create demand, which devalues the value, your money, your savings to try and encourage you to spend, then you always have to have more debt. And I presented this for many, many videos over the years and in my book, Bank to the Future, which came out in 2011. Really, the pinnacle of the debt cycle was you need governments to take on more debt, companies to take on more debt, and individuals to take on more debt. In a system where there is more debt than money, so you always have to roll over the monetary system in order to prevent recession. That causes inflation and various other things that I've covered over the years on my video. But the 2008 one was a way of getting individuals, consumers deeper into debt. And what it was in its essence is they found people that wanted to take on mortgages because real estate is the mechanism for banks creating money every time they issue a loan. 97% of money is created by a bank. The way you do that is you get the loans through retail banks and brokers, and they created a way of packaging those loans up together into what was known as a mortgage-backed security. Fancy for packaging all those mortgages up, creating a financial product, which is tradable on an exchange or over an over-the-counter market. And then you can get the investment bank to package them all up, and then they can sell them to your pension or all the big pools of capital known as the buy side. The investment bank is the sell side, the fund and your pension is the buy side. You put your money in, you put insurance premiums in, they buy the products, the investment bank packages it up, and it was taking all the loans from the retail banks. When all that blew up, because pensions were on the line, banks went bust, they had too much exposure, and so we had to pass it all on to the central bank. So when individuals are maxed out on their credit cards, companies are maxed out on their credit cards, governments are maxed out on their credit cards, you need to put it all over to the central bank to keep the Ponzi scheme alive. That was 2008, that fixed itself. Companies went down, the Fed gave money to other companies, and depending on whether you were on the right side of BlackRock's algorithm that was advising the Fed, then you survived like JP Morgan or you died like someone else. Okay, so then in 2009, we had Bitcoin, banks on the brink of financial disaster. It was put into the blockchain, and Satoshi Nakamoto mined the first block, and we created an alternative financial system that allows you to own your own money, spend your own money, and has a fixed supply so that when governments print money, the relative value of Bitcoin is designed to go up over time. Okay, then what did we do in order to fix the system? Well, we wanted to get everyone deeper into debt. The way the government solves a debt problem is create more debt, of course. So how do you create more debt? Well, you encourage people to borrow. How do you encourage people to borrow? You make their mortgages a lot cheaper. You make their credit cards a lot cheaper. You decrease interest rates so the banks then can then borrow at very, very cheap rates, charge you a bit more, and the lower the rate, the more likely you are to be able to afford it. And therefore, you pump the economy through debt, aka Keynesian economics, forget the wealth effect. You create this wealth inequality, rich-poor divide, where those that borrow to buy assets win, and those that borrow to consume lose, and you get this rich-poor divide depending on whether you're investing or not. Okay, this is when I released in 2009 a presentation that I uploaded to YouTube in 2011 called The Great Depression of the 2020s, going through these effects on presentations I was giving. Wow, how long ago was that? 12 years ago that we uploaded it, 13 years ago. And I then spoke at the first Bitcoin conference because we were trying to create a bank that doesn't create money. We found Bitcoin, and I released my book, Bank to the Future, Protect Your Future, before governments go bust. You can still get a free copy on that website as well, the PDF version, because it's still relevant today. And so the 3 rules, and this gives you all the background knowledge you need to understand the current situation that I have been sharing, that I presented at that first Bitcoin conference, covered in the book, and even before Bitcoin at monetary reform presentations, is 3 simple things. The rules of banking. Banks own your currency. I say currency rather than money because currency, fiat currency, is created by a bank, and it's a representation of the money you think the government creates. When you deposit money at a bank, the bank becomes the legal owner of your money. Then banks can spend your currency as well. And they spend it by lending, rehypothecating it and directing the flow of money to what they consider a good risk. If those risks go wrong, then your money is used for bad things that can go wrong against you. But also they create your currency. So every time they issue a loan, they create a new balance, and therefore they create money as debt. Debt becomes money, and this is the Ponzi scheme called fiat currency. Okay, so that was the presentation that I gave. Oh, 1 second, I've just got my phone that just came on. Okay. So in 2020, when very early, I wanted to show people how to prepare for the Great Depression of the 2020s. Real estate was still pumping. The government was pumping money into the market. Everyone was taking the piss out of me, saying it's not going to be here. And then a little bit further down the pandemic, we created an effect where we printed so much money that we really hyper-accelerated the Great Depression of the 2020s. So I went on YouTube, created a 4-part video series that's still live on this website, preparing people, and I invested $1 million of my savings live to show you exactly how I was preparing for it. Then we entered into the pandemic, we reacted, and we decided that we were going to keep interest rates down in order to, for that market. And so obviously we went into quantitative easing, which is where we printed more and more money. Governments and central banks took on all the debt in order to keep the economy alive, shut down the economy, keep interest rates low so that you could borrow some more money, and everyone went on a speculative frenzy and they kicked the can down the road a little bit further. Now, obviously, that starts to have an impact, which brings us to where we are. Everyone took that money that they were given for free from the government with low interest rates. Companies came along and started borrowing money at very cheap rates and pumping it into the stock market to buy back their stocks. Individuals speculated when they had funds left over based upon those funds. And we created a stock market, frenzy where valuations went completely out of control until the bogey monster called inflation comes along. Bitcoin, obviously, it went through its 2020 halving cycle. So it's designed where every 4 years, the number of Bitcoins that get created halves, which gives it a fixed supply of 21 million Bitcoin through a very well-defined release schedule. So you never have to worry about what the central bankers are doing because there is no central bank and there is no government. You can spend your money, own your money, and you know what the supply is going to be at all time. Okay. Now, in order to support the industry, to help people get off of fiat and into Bitcoin and into the crypto markets, you needed crypto-friendly banks. So you've got to be able to take your fiat currency. I take my fiat currency. I've been doing this for over a decade now, and I convert a fixed percentage of it into Bitcoin for my savings and keep the amount that I need to meet my living expenses. You need a bank to do that. So we had these crypto-friendly banks, Silvergate, Silicon Valley Bank, and Signature. Silicon Valley Bank was really focused on the tech startup scene. A division of the tech startup scene is Bitcoin and crypto markets, whereas Silvergate and Signature were kind of traditional banks, and they used innovation in order to allow all the exchanges to trade amongst each other, which caused a bunch of issues as well. Now, with all this money printing, eventually the bogey monster called inflation came along. We hit the cost of living crisis. We had these crypto-friendly banks. Deposits were going insane as more and more people were converting into crypto. More and more people were investing into Silicon Valley startups. People were contributing more to their pension. The pension was then investing more into venture capital. As we were having that, boom market, we hit it into an inflation market. All of that debt reaches the point where people can no longer afford to take on a mortgage. Their wages are not going up at the same rate as their debt's going up, and more of their money is servicing debt. You have all these impacts and this money increase in the money supply, and everything goes up. That you need just one supply side shock. And in order to combat that, inflation was going berserk. So the Fed had to hike interest rates, and that brings us to the effect that we had starting from the inflationary cycle in 2022. So these crypto-friendly banks and these Silicon Valley Bank entered in a stage in the bull market where they were getting more and more deposits at a faster rate than they could lend out money. Now remember, they create money when they issue loans, and they need to have deposits in order to meet their regulatory requirements in case people need to withdraw funds. And that's a tightly regulated industry, and you have to have capital requirements and all sorts of banking regulations in order to keep that industry steady. So the deposits were increasing at a faster rate than loans. Crypto was going berserk. The market was going. And essentially, in order to, because they couldn't keep up with loans on the banking model, they invested in longer term debt. So they lent it to the government for bonds that were lasting for like a 10-year. That's a security where you lend money to the government. They were investing it in longer term 10-year debt, and they were subsidizing it through, guess what? The thing we did in 2008, mortgage-backed securities. And so they were investing in these products, and these products have a longer term, whether it's 3 years or whatever it may be, which means that your money is locked in unless you can sell it. And there's liquid markets for people to sell to each other. And so they're just managing their risks, and the risks got completely out of whack because they couldn't lend at the same rate. In fact, in Silicon Valley Bank, they were doing things. They had a very niche model where they were servicing businesses. businesses, you can get deposits account, but getting a loan for a business is virtually impossible at a traditional bank. So you have to end up going to a company like Silicon Valley Bank if you're a Silicon Valley startup and tech startup. And they were doing things where, for example, the founders could use their stock as collateral in order to take out a loan and then buy their houses in a cost of living crisis where the price of real estate was becoming unaffordable in San Francisco and Palo Alto and all these different places. And the belief was that the company was going to go public in the future. So it's a very, very niche, hard, longer term debt corporate book. And venture capitalists were using it as their bank, and they were saying, we'll put the money in your Silicon Valley bank account. And so it had all the concentration of all the different tech startups and all the companies that went from real early stage to very, very large tech giants as well. They also, the crypto-friendly banks, used the fact that they were servicing over 1,300 different crypto companies and exchanges to use blockchain innovation to allow them to have 24/7 interbank markets where you could transfer from one exchange to the other. And this got them in a little bit of trouble when the Department of Justice started looking at companies when you had fraudulent companies like FTX that were using these services. And they were transferring funds to each other between stablecoin issuers to exchanges and everything in between. Now, all of a sudden, we hit the hikes where the interest rates went up. And this had a knock-on effect that caused havoc for these companies' business model. And many other banks, including the biggest bank in the world, the Federal Reserve. Now, it didn't mean too much to the Federal Reserve, but they were also on the wrong side of this, because when we did quantitative easing, which is the process of the central bank buying all these assets, buying mortgage-backed securities, they were essentially doing the same thing as Silicon Valley Bank, but obviously they're a central bank. So these hikes started to devalue existing bonds. The reason for that is because as the government operates off a Ponzi scheme, they need to issue more bonds. And because interest rates are going up, you were suddenly able to get 5% on a short-term treasury, which is a loan to the government for about 3 months. And if you can get 5% off a government bond, treasury for 3 months, why are you going to lend to the government for 10 years at a lower rate? So it destroyed the market that all of these banks had invested into. Now, that's okay if you can hold it for the 10 years, but what if you can't hold it for the 10 years? And that's exactly what happened here. So treasuries were paying higher rates, and you had these fraudulent crypto companies like the Celsiuses, the FTX, the 3 Arrows Capitals, the Terra Lunas, that were all on the wrong side of these, were not prepared. They had big holes in their balance sheets. They were spending client money. They were betting long, and they were doing pumping tokens, using illiquid tokens in order to make themselves look bigger and raise funding, and all the models that we've covered previously as well. And so because of that, when those companies blew up, there was a big decrease in deposits. The reason they're called demand deposits is because people started demanding more deposits. But those deposits were locked up in longer-term bonds and mortgage-backed securities. So all of a sudden, the demand was greater than the deposits that they had. A couple of months ago, I released this video because no one was covering Silvergate. It was completely underreported, but it was the huge systemic risk event that I was trying to warn people against as a result of being that bridge between crypto and all the fraud that was happening in the crypto side and the fraud that happens in fractional reserve banking. And therefore it was exposed in between using those combinations. So I tried to warn it and no one was really covering it. That's when you can go back to that video. But essentially, they had to sell their assets at a loss. So they took those assets. And remember, because you can get 5% on a short-term loan to the government, if you want to sell a 10-year loan to the government that has a much, much lower interest rate, the only way you can sell that is someone that's willing to buy it at a discount. So rather than paying $1 for it, you might pay 80 cents for it. The problem is it's worth $1 if you can hold it for 10 years, but if you need it now, you have to sell at a discount. So this locked in a huge loss because Silvergate needed to meet the demands in order for those crypto companies that wanted their money out because of that. And Silvergate essentially locked in a $1 billion loss towards the end of 2022. They're a public company, so they had to report it, causing further and further panic at the bank for those that wanted to service it. At that point, which is going to be a very interesting subject, the directors, the CEO, the CFO, and the CMO started selling big chunks of their stock onto the market. Very suspicious activity. At that stage, Moody's, the company that puts a credit rating on these banks, contacted on the 1st of March, last Wednesday, Silicon Valley Bank, saying that you're about to receive a downgrade. They went into emergency mode in order to try and not spook the market. They called up Goldman Sachs. Goldman Sachs put together a plan that looks something like this. And here was the plan. The plan was to sell $20 billion of low-yield bonds. And I think they wanted to also sell some stock, but they wanted to sell the bonds. But remember, you could only sell them at a discount, which means that you'd have to lock in a loss. So they have to figure out how to cover that loss. And with that money, they wanted to buy higher yield treasuries. So the government and the central planning had completely screwed up the system. They hadn't managed their risks. Demand deposits were coming in, and all they had is assets that they could only sell in distress, and Moody's was about to downgrade them. So they realized a $1.8 billion loss at Silicon Valley Bank. This $1.8 billion loss would obviously spook the market, so they needed to sell approximately $2.5 billion of equity. So they went out there, tried to sell the equity, tried to issue new equity, and they didn't have time to sign non-disclosure agreements. They went out to the investors. Obviously, the private equity went to their friends at the venture capital, the Goldman Sachs, everyone was interconnected, tipping off people, and we ended up where they got 500 million confirmed, but Moody's went out there and made the announcement, a smaller downgrade because they'd done it than they originally, and that spooked the market, and those insiders started to withdraw their deposits. The price of their stock crashed approximately 60%. And I released this video where I was talking about the death of Silvergate, because Silvergate went into voluntary liquidation. You can go back to the videos and see the live coverage as we were doing that. And Silvergate also crashed as well and went into liquidation, which brings us to where we are now. And Peter Thiel, Founders Fund, and Marius started warning all their startups. All the VCs pulled out their money. Then people went on TV saying, we pulled out our money, and approximately $43 billion of startup funding that had all come from the venture capital industry into the most important technology companies was withdrawn from Silicon Valley Bank, which meant that the FDIC had to come in. And they came in this Friday. We're now on Sunday as I cover this, and they are announcing today what they're going to be doing. They've been working all over the weekend, and an announcement will come out today, which will be executed on Monday, and we are expecting several things to happen. Okay, so what is the solution from here? Well, just understand the fact here. 97% of all the depositors at Silicon Valley Bank are technology companies. Now, FDIC, the Federal Deposit Insurance Corporation, they insure up to $250,000. So if you've got $250,000 in these banks, you should be able to get those with no problem, unless it has an impact on other banks, because FDIC cannot cover everything if more than a few banks go down at the same time. And so we have to go through an FDIC restructuring. And maybe we do the 1907 or 2008 JP Morgan takeover strategy, or maybe we do a Fed bailout. Now, today they announced that. So let's go through the relative strengths and weaknesses of each one so that we're prepared for what comes next. The FDIC restructuring. Now, remember a few things with FDIC. It is insurance that guarantees $250,000, but this only got $2.27 billion, insuring over 8.8 trillion. Last time I covered this on my YouTube channel and did a deep dive into FDIC a couple of years back. I think it was in 2021 when I last did a deep dive. But also, they don't hold their money at a bank, they lend it to the government. Why? You can't insure a bank and then hold the money at a bank. So it's basically backed up by the same products that cause the issue in a low interest environment. So the value of their assets are also going down because it's held in treasuries. And so FDIC need to come in and make sure that they don't cause a spook in all the different banks, because if one bank can go down, then everyone starts asking questions about all the other banks as well. And it causes a run on the banking system, exposing the complete fragile nature, which is why now all governments are working all weekend in order to decide what's going to happen here. Well, what they probably announced is a private solution. So if you were involved in any of the crypto Chapter 11s, because those were illegal banks, essentially, that didn't have the licenses and didn't have the risk management strategies, they don't just get taken over. They have to go into a massively long bankruptcy process where they start clawing back money from each other. It causes systemic risk when one company is bankrupt and another company is all clawing back money from each other. In the banking system, when I originally gave, for example, Celsius a reorg plan, I told them, you got 2 weeks to solve this one before it spirals out of control. Because it wasn't solved quickly, like last time we did this with Bitfinex in 2016, it became a much, much bigger issue. So in the takeover issue in 1907, JP Morgan, they essentially said, we'll buy your banks for nothing, but we'll lend you the money to solve your issue. And they did the same in 2008, but it was more sophisticatedly done via the Fed, where BlackRock was telling the Fed what to do. The Fed was lending the money to the company based upon BlackRock's algorithm. Then JP Morgan was allowed to acquire the banks, and Lehman's went bust and Bear Stearns went bust. But is JP Morgan really in the venture debt market? This was a very niche bank. It's got 65,000 small businesses and technology companies. It's got very niche products which are completely unique to the Silicon Valley market. Traditional banks consider lending to businesses of this stage very, very risky. Remember what they did in 2008? JP Morgan said, I'll have Bear Stearns at $2, we'll borrow the money from the Fed in order to bail out. What about the Fed bailout? Well, I've posted this little tweet here. If you go to my Twitter to keep up to date, from Ram gave a very interesting post. But look at the Fed situation right now. They are in the same situation as Silicon Valley Bank. As we said, they've been doing quantitative easing, and they have been buying mortgage-backed securities in order to implement to try and control inflation. Remember, they switched from quantitative easing to quantitative tightening as well. So they've been trying to sell and offload their books, selling at potentially distressed prices as well. And they're currently losing approximately $2 billion per week from all the work that they were doing in intervening into the market. And essentially, they are exposed the higher the interest rates go. Now it's the Fed, it's a different game, but the Fed may need to bail out the FDIC, and that has happened before, for example, in the savings and loans crisis. The Fed, the central bank had to, in fact, that's how FDIC was created in the first place, because it had to bail out SLDIC in the last savings and loan crisis. So let's just think about what this impact has on the wider crypto markets before I head over to the spaces, to Twitter as well, to see what's happening in the live market. Well, here's what we know about some of the, on Twitter, some of the banks and their deposits at Silicon Valley Bank. In terms of crypto companies, we know that, for example, BlockFi, they sold all of the client crypto and Bitcoin was the solution to this problem, converted it to $227 million and put it in Silicon Valley Bank. That's disastrous. In fact, the worst situation that could possibly happen. So they're completely dependent upon what happens at Silicon Valley Bank. But the biggest creditor was Circle, and Circle, full disclosure, I'm a shareholder in, and they are the creator of the USDC stablecoin. So let's have a quick look at that so that we can understand why Monday is such an important date. because the stablecoin US, they all started depegging and trading away from a dollar. For those of you not familiar with stablecoins, it's essentially a way of sending funds on a blockchain by having it backed by dollars and treasuries. And so that for every dollar stablecoin, there is a dollar cash or cash equivalent or treasury behind that. And if it's no longer backed, it depegs and it has an issue because it's no longer worth a dollar. So immediately USDC stablecoin started trading to a low of 87 cents on the dollar. It's currently come back around 95 cents on the dollar, but it went from a market cap of about 41 billion to 39 billion. So $2 billion was redeemed before this, and it was converted into Tether. Tether is the original stablecoin, and that was trading at a premium. So people were paying more than $1 in order to try and reduce some of their risk. It was a peak at $1.03. It's now about $1.01. And the market cap went up from about $70.5 billion to now about $72.5 billion for that. BUSD, Binance stablecoin, if you've watched any of my previous videos on investigating Binance, they had the issue. So they had a massive outflow of $16 billion over to $8 billion in their stablecoin, but the price is stable around that. And the small one, Gemini US dollar, they went to discount premium, but it's only about $600 million, so it's a lot smaller than the others. So we had all these trading stable coins based upon people trying to do, look at where the risk is, because Circle had exposure to Silicon Valley Bank. So let's have a look at the exposure. Well, if you look at that $38 billion that's backing the USD stablecoin, approximately $32.4 billion, 77% of it, is held in US treasuries. So that means it's the US government's credit rating that is backing USDC stablecoin. Okay, great. But what about the rest? Well, $9.7 billion is to meet redemptions. And so it's held at cash in a bank. That's 23% of the stablecoin. So let's dig a bit deeper. Where is that cash held? Because remember, FDIC only insures $250,000 at each bank. Well, $5.4 billion of it was transferred when Silvergate went bust over to Bank of New York Mellon. Dodged a bullet, went over to Bank of New York Mellon. But $3.3 billion of it was left at Silicon Valley Bank. This is what caused the depegging of USDC from the $1 price. Now, of that $3.3 billion, it is the outcome of what is announced on Monday that will determine whether USDC is backed or not, because they have a legal requirement to back it by the funds in the company as a regulated money transmitter, or go out and raise that capital. And they have said that they will keep that promise in order to make sure. So it's currently going to be backed by FDIC IOUs. The market is saying that they're probably going to restructure. Silicon Valley Bank will sell off all its mortgage-backed securities, sell off some of its assets at a discount, lock in whatever the size of the hole is. We will find out on Monday or at the announcement today. And they estimate about 50% of it will come back. So that 3.3 billion turns into, what's that, 1.65 billion. And then they will have a mechanism for unwinding those and maturing those over time, whether it goes to the new bank, whatever it may be, whether it goes into a bailout, and that's the exposure that they need to plug. I anticipate them being able to plug that, but that's what happened in USDC. Now, they've also got $1 billion at a bank that they would probably have to clear through Signature. So there's exposure there, and Signature is probably just as distressed at this stage and having very similar issues to Silvergate. Now, what can they do in order to raise that funding? Well, they can do exactly what we did in 2016 with Bitfinex. When Bitfinex, they had 2 weeks to do that, Bank to the Future and Bitfinex, because we didn't want to see what happened at Mt. Gox in 2014, where depositors lost a load of their money. We figured out a mechanism for giving the debt to the creditors, to those that had funds, allowing it to trade on a market, convert it to equity, at a fixed price or hold it. If you want to watch more on how we did that in 2016, check out this video on the Bank to the Future YouTube channel. We went through a bit more on that. All of these companies in the crypto space, they have this is some of the USDC holdings that we know about. So it can, if they don't solve that issue, so let's work backwards. USDC, all of these companies have exposure to USDC. USDC, we don't know the extent of the hole until we know the solution to Silicon Valley Bank, and we've had this intersection between traditional fractional reserve banking and exposure in the crypto markets. But guess what? The reason that we created Bitcoin in the first place is the same reason why it's the solution to this for those that don't want to take bank risks, that want to own their own money, spend their own money, and have a combat against this money that gets created every time they need to save the regulated Ponzi scheme. And so Bitcoin is still solving the same problem that it originally solved and why it was created in 2008. But now I'm going to save this because we're going to head over to Twitter Spaces. But I just want you to understand the wider geopolitical war here and why this is important, and they won't just let a bank go bust. The reason for that is because it is 97% of those deposits are people that have technology companies that have massive exposure, greater than 250,000. And if they can't pay their wages, because Silicon Valley Bank had automated payroll because they weren't paying interest rates and other type of products, if they can't meet that payroll, we're going to have a ginormous amount of technology companies in America, in Silicon Valley, that will have to lay off their staff, focus on profits, tail down innovation, and you'll have a ginormous contraction, just like we saw in 2000 during the dot-com boom and bust. All of this at a time when geopolitical warfare is incredibly important. So to close off, I just want to go through, and I'll cover this in greater detail in a further emergency broadcast once we understand a little bit more about what's going to happen today. But you'll see right now venture capitalists going round and saying, FDIC, we need you to insure the system, because they want a riskless bet. Now, obviously, the venture capitalists, they can have and come up with their own solution. Venture capitalists should be able to solve a Silicon Valley should be able to solve a Silicon Valley bank problem. And the only reason they're not is because they want FDIC to guarantee the system so that they can socialize some of the losses, or guarantee some of the losses, so that they can have all of the gains as well. We're going to get the announcement on what this is, and we'll be covering commentary all around that as well. But the reason that it's so important is because essentially this is one of the most important sectors for United States competitiveness. They are at the end of a 100-year debt cycle, as I've covered in all my other previous emergency broadcasts. Remember, if you go to some of those links where you can get my free book, you can see all the other emergency broadcasts where I covered the IMF trends, the China-US, the US executive order, the Russia-Ukraine trends, the Taiwan and China trends. All of this comes into play because we are in the midst of a technology war between China and US as we speak. China is outpacing growth of investment through the government in technology, in artificial intelligence, in big data, in big computing, and the US cannot afford to slow down. So they will see this as a risk to national security at a time when they are fighting over the Taiwan situation, where China wants to reunify because Taiwan is producing all of those semiconductor chips that are going to powering all this 5G, which China is using their IMF model, using their Belt and Road Initiative to create a Silk Road so that they can launch their central bank digital currency, so that they can lend to countries to roll out their 5G and their AI technology in order to win the battle for the world reserve currency. So if you create a politically unstable situation right now, it will be considered a national security risk. And Silicon Valley Bank is that perfect storm if they let all of the technology companies lose their deposits, and so it becomes geopolitical. And then you are going to see whitewashing and various different ways. They've announced today that they're not doing a bailout because they know that will cause riots on the streets, because the reality is China is prepared for this. They launched their central bank digital currency, which, as I said in my book in 2011, that the only way to solve a Ponzi scheme is to deleverage the Ponzi scheme by injecting a new money supply and take down the banks. And that is what a central bank digital currency does. In China, they already have 215 million wallets available. They've integrated it, ready for launch with Alipay. They've already got and WeChat Pay. They've already got 1.7 billion people using digital payments. They are way ahead in terms of fintech. They've already done about $250 billion of transactions in beta. About $15 billion of transactions in beta to $250 million wallets, while the Fed still is not anywhere closer to getting their Fed coin out for cultural reasons, because central bank digital currencies are the biggest attack on freedom the world will ever see, but they are inevitable, predictable, and guaranteed. I'm not going to go any further. I'll cover more in emergency broadcasts where we start to see how the central bank digital currencies are going to be used. But this is a systemic risk event that is going to be solved. Whatever they announce on Monday, I think it's going to be an FDIC guarantee on the banking system to stop the panic. And then all the VCs are going to come in and try and bail out for pennies on the dollar. And use the government in order to make an absolute killing, wipe out all the equity, so it's not an outrageous, bailout like it was in 2008. Wipe out the shareholders, but make sure that people don't lose their deposits. Roll over the Ponzi scheme, recycle the debt. Maybe they put some of those assets on the Fed's balance sheet, roll them out to maturity, and have a plan of how they do a controlled liquidation or takeover. All of those can happen, a combination of all the above, but we're about to see in real time, because they don't have their central bank digital currencies, I expect this to be the last rollover of the Ponzi scheme until they implement a central bank digital currency where they let banks go bust and they allow you to download a wallet and deleverage the debt from the system, auction off all the debt, as I predicted, inevitable, predictable, and guaranteed in my 2011 book, which was the first published book in the world to include Bitcoin. And if I wasn't dealing with all these chapter 11s right now and restructuring of companies in the crypto markets, I would have had my next book, which covered many, many of those trends, which I will make sure that I get out this year if we don't have too much more restructuring to handle. So always remember, you are alive at one of the most interesting and exciting times in financial history. Do me a favor, if you like this content, after 3, 1, 2, 3, hit the like button. 1, 2, 3, hit that like button right now. Do me that favor, because YouTube algorithms need that in order to stop the shadow banning. They don't want this content to get out. Hit the subscribe button, hit the bell symbol, hit all, because you are alive at one of the most interesting and exciting times in financial history. Many are going to get wrecked. Others are going to do very well. I want to make sure that you're on the right side of that change. We do it with peace. We do it with love. We do it with unity. And all of these numbers are just essentially financial innovation that we need to restructure. And I'll keep you up to date with all of those changes. I will see you over on Twitter right now, where I'll be joining in spaces where we innovate the future of finance. Peace.